Oil racing toward $100, bond yields breaking higher, and AI heavyweights under scrutiny on spending are forcing equities to reprice risk in real time. Welcome to vTalkInsight, Equity Pulse Daily for July 24, 2026. Global equities are now trading against a much tougher energy backdrop, with Brent crude pushing toward the $100 mark. Disruptions around key shipping routes mean this is not just a cyclical upswing in prices, but a geopolitical shock with direct implications for inflation and equity valuations. Renewed Houthi attacks on Saudi oil tankers in the Red Sea, combined with concerns around the Strait of Hormuz, have turned maritime routes into active pressure points for crude supply. On top of that, risks around the CPC pipeline in the Black Sea are layering another constraint, helping push Brent above $96 to $97 and roughly 30% higher since the latest Middle East escalation. Earlier resilience in the oil market relied heavily on softer demand, especially from China, and extensive drawdowns of commercial and strategic stockpiles. Those buffers are now notably depleted, so every incremental disruption carries more pricing power, which in turn feeds back into inflation expectations and term premiums in bond markets. Crude has risen for a fifth straight session, and the message is showing up in rates. U.S. Treasury yields across the curve have reached new highs for the year, with 10-year yields at their highest since early last year, and some seeing scope toward 5% if recession is avoided. In Europe, rising oil and gas prices are lifting inflation risks and keeping pressure on the ECB, where markets are now pricing in additional hikes even though policy is only around 2.5% and still viewed as below neutral. The Federal Reserve faces a more nuanced picture. Recent soft CPI and core PCE prints point to cooling inflation, and there is little evidence yet of energy costs feeding through into core measures, which reduces immediate pressure for further hikes. Even so, markets are starting to price in a chance of another Fed move by year-end as oil-driven price pressures and extremely low jobless claims around 187,000 keep the narrative of persistent inflation alive. Policymakers are also changing how they communicate, with the Fed shifting away from explicit forward guidance and making every meeting a live event driven by incoming data and market signals. That could mean more frequent, smaller adjustments in short-term rates to stabilize longer-dated yields, raising front-end volatility just as elevated long-term yields, a positive stock-bond correlation, and rising oil all compress the equity risk buffer. Equity markets are already reacting. A broad-based sell-off saw the S&P 500 drop about 1.2% and the Nasdaq fall more than 2%, with over 300 S&P names in the red and large-cap tech leading declines. Volatility indices have pushed back toward the high teens, and with traditional bonds no longer providing reliable diversification, upcoming events like the FOMC and Bank of England meetings, hyperscaler earnings, and developments in the Middle East all have the potential to swing equity risk appetite sharply. The dominant equity narrative inside this macro backdrop is the collision between huge AI growth expectations and mounting concern over how much big tech is spending to chase that opportunity. What started as a straightforward AI rally has morphed into a tech-led drawdown as markets scrutinize who can turn massive capital expenditure into sustainable cash flow. Alphabet captures this tension well. Its cloud business just delivered around 82% growth with margins close to 36%, confirming robust AI-related demand and making cloud the main top-line driver. Yet the company also plans to lift annual capital spending to roughly $25 billion, tipping free cash flow negative and even renting compute capacity at above market rates despite its stake in SpaceX, stoking worries about efficiency and future margins. Alphabet is not alone. Major hyperscalers including Google, Amazon, Microsoft, and Meta are all locked into a multi-year infrastructure arms race, with each expected to deploy well over $200 billion into AI data centers over time. AI-related Capex has been growing around 75% annually for 3 years and is expected to slow to about 40% next year and 20% thereafter, which is still enormous and keeps pressure on these firms to justify the spend. Institutional investors are increasingly pushing back on the idea that any AI investment is good investment. insisting instead on clearer evidence of revenue and margin uplift. Enterprise AI budgets are likely to be examined much more closely over the next year or so, raising the risk of overcapacity in infrastructure if demand does not scale as quickly as current build-out plans assume. In the near term, the clearest winners remain infrastructure and hardware suppliers into the AI stack, where revenue is realized upfront while software and cloud returns are delayed. Intel's latest quarter illustrates this, with revenue of about $16.1 billion and earnings per share roughly double consensus, driven by a 59% surge in data center sales as enterprises ramp AI compute, while Micron benefits from tight memory supply as hyperscalers and Tesla lock in capacity. Even here, the market is selective. Intel's turnaround is still early. It faces intense competition from NVIDIA, Google, and AMD in AI data centers, and its push to win external foundry customers comes as the stock trades near 95 times forward earnings, far above history and peers, highlighting valuation risk. Other chip leaders like TSMC and ASML have reported strong results only to see shares fall, while European tech shows a similar divide, with ST Microelectronics punished for weak guidance, even as names like Soitec and Nokia benefit from AI and cloud demand. Tesla underlines how quickly sentiment can turn when AI ambition collides with financial reality, with a strong revenue beat driven by aggressive discounting, but earnings per share missing by more than a third and roughly $5.8 billion of quarterly Capex, leading to its first cash burn in 2 years and a share price drop of about 15%. Speculation about a potential Tesla and SpaceX combination points to the scale of capital the AI race may require, yet regulatory scrutiny could slow such moves, reinforcing the broader shift from rewarding AI vision to demanding clear, funded execution. Against this volatile tech backdrop, there are signs that equity leadership is quietly broadening toward financials and related sectors. Earnings revisions are running at their strongest pace in decades, and while returns are still heavily concentrated in semiconductors and large-cap tech, banks and alternative managers are emerging as important counterweights. BNP Paribas has reported a 43% year-on-year jump in equities revenue to about $1.6 billion and double-digit top-line growth with a 33% rise in profits, helped by strong prime services demand from hedge funds across the U.S. and Asia. The bank is still adding generic provisions for geopolitical risk despite stable underlying credit costs, while UniCredit has beaten expectations, raised guidance, and announced new dividends as it moves toward majority control of Commerce Bank, setting up meaningful restructuring in German banking. Lazard's asset management arm has just delivered its best net flows in 2 decades and record assets under management, underscoring renewed client appetite. On the advisory side, after years of heavy turnover, its managing director base is now a tailwind, with next year's weighted backlog more than doubling, pointing to a stronger deal pipeline into 2027 as confidence in corporate activity slowly improves. Alternative asset managers are also leaning into structural themes, with Blackstone posting a 26% earnings increase on the back of early moves into AI-linked data centers and battery storage, and recent exits of around $8 and $7 billion respectively, highlighting deep investor demand. At the same time, private credit is experiencing both stress and growth, with pressure in highly leveraged software names exposed to AI disruption, but a structural increase in supply in investment grade and infrastructure credit and renewed stability in retail vehicles, while middle market lending broadens into sectors like food, beverage, and landscaping. With the traditional negative correlation between stocks and bonds having flipped positive, it has become harder to hedge equity risk using government bonds alone. In that context, the growing earnings contribution from banks, asset managers, and alternative platforms provides an additional pillar of diversification within equities, particularly as they intermediate the same AI and infrastructure themes currently unsettling parts of the tech complex. Outside finance and technology, several sector-level signals are shaping where the next leg of equity leadership could come from, starting with autos and the energy transition. European car sales climbed about 13% year-on-year in June, with plug-in vehicles now more than one-third of new registrations, while suppliers like Valeo are on track to meet full-year targets thanks to better-than-expected sales, pricing initiatives, and cost reduction plans. Daimler has upgraded guidance for its U.S. truck business, citing favorable local content rules and tariff decisions that enhance its manufacturing position in North America, illustrating how supply chain rewiring and industrial policy are reshaping profit pools. In parallel, defense companies such as Lockheed Martin and RTX are reporting strong earnings and raising outlooks as global military spending increases, while European peers like Dassault and Thales are outperforming on the back of heightened geopolitical tensions and sustained rearmament. Healthcare is another bright spot, with Roche gaining share despite a slowing U.S. pharmaceuticals market, supported by its multiple sclerosis portfolio and a new breast cancer treatment showing around a 30% improvement in recurrence rates and receiving priority review from the FDA, potentially influencing global drug pricing debates. In media and telecom, Comcast has achieved profitability at its Peacock streaming service thanks to strong sports and Spanish-language programming, yet faces persistent broadband subscriber losses amid tougher competition from players like Starlink and some softness at its Orlando parks. Even as a potential separation of media and cable assets raises the prospect of value unlocking M&A around NBC Universal toward 2027. Beyond these names, investor interest in logistics real estate is increasing as limited new construction and deals such as Prologis's activity in the UK underline confidence in warehousing and e-commerce demand. Liquidity remains strong in AI-unaffected areas like medical supplies and fast food, and together with energy, autos, defense, and healthcare, they help broaden an equity tape that had been dominated by a narrow group of AI and semiconductor winners. Stepping back, equities are being pulled between a tightening energy shock, higher and more volatile bond yields, and an AI Capex supercycle that is now facing much tougher scrutiny. Oil near $100 and depleted buffers are feeding inflation and rate worries, eroding the old stock bond diversification play just as big tech spending plans force a reset in expectations for margins and free cash flow. At the same time, banks, private credit, alternatives, autos, defense, healthcare, and select real assets are building steadier earnings momentum, suggesting that leadership is broadening even if index-level moves remain hostage to geopolitics, central banks, and hyperscaler guidance. From here, the key signposts are the next round of FOMC and Bank of England decisions, incoming core inflation data, hyperscaler and semiconductor updates on AI monetization, and any further disruptions across critical energy choke points. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.